Today, we are talking all things interest rate, including what an interest rate actually is, the difference between fixed and variable rates, who sets your rate and why it changes, and how to plan for future rate rises so you feel calm and prepared. So let's jump in. Hello, and welcome to First Home Unlocked, the podcast for unlocking clarity and confidence for first home buyers. I'm Jack Elliott, National First Home Buyer Specialist at Alcove.
And I'm Chris Bates, ex-financial planner and mortgage broker.
Together, we are on a mission to empower you with the keys to unlock your first home. Let's jump in. Hello and welcome back to First Home Unlocked. Chris, how's the day been?
Going good, Jack. I mean, I've always loved doing these episodes with you, and another big one today. Yeah, looking forward to a weekend up the coast, actually. We're going to Wamberal, which is up on the Central Coast, for a night at a friend's house, and then up to Newcastle. What's news with you?
No, not much. Just, getting into the end of the year. So really loving having plenty of conversations with first home buyers at the moment. And like you said, today's a big episode. So today we're going to be diving into a topic that every first home buyer cares about: interest rates. So whether you're buying your first home now or planning to buy in the next 6 to 12 months, your interest rate will shape your repayments, your cash flow, and how confident you feel on your mortgage. Now, here's the key thing to understand right up front. Your interest rate will change over time. It's not something you lock in forever. They will move, and that's just a normal part of having a home loan. A lot of first home buyers naturally focus on getting the best rate, and yes, your rate does matter. It has a real impact on your monthly budget and how comfortable the loan feels day to day, but it's not the whole picture. Long term, your strategy, your loan structure, your buffers, and how you manage the loan over time will matter far more than chasing the lowest rate. But today we are talking all things interest rate, including what an interest rate actually is, the difference between fixed and variable rates, who sets your rate and why it changes, and how to plan for future rate rises so you feel calm and prepared. So let's jump in. All right, let's start with a quick refresher on what interest rates actually are. We covered this in episode 21, Unlocking How Your Mortgage Actually Works. So jump back to that one if you haven't listened yet. An interest rate simply is the cost of borrowing money. When you take out your home loan, you're repaying the amount you borrowed plus an extra percentage on top, and that percentage is your interest rate. So if your rate is 5.45%, it means you're being charged 5.45% per year on whatever amount you still owe the bank. And even though your interest rate is shown as a yearly percentage, interest is actually calculated daily. Every single day, the bank looks at your remaining loan balance and charges the interest on that amount pro rata. So that means even small reductions to your loan balance reduce how much interest you're charged because the daily calculation drops. And higher interest rates mean higher repayments because you're being charged more to borrow the same amount of money and vice versa. So interest rates exist because lending money is risky. Interest is the bank's fee for giving you their money up front and taking on that risk. It's also one of the main ways banks make money. Without interest, banks wouldn't lend. So the simplest way to think about it is on a mortgage, you pay the bank for borrowing their money. And then on a savings account, the bank pays you because they're using your money to lend to others. So at its core, your mortgage interest rate is just the price of borrowing money. Everything else we're going to cover today builds on this idea. Now let's do a quick refresher on fixed and variable interest rates first. We also did cover this in episode 21 as well, so definitely jump back to that one if you want the full breakdown. But let's keep it simple today. A variable rate first moves up or down over time. It's the most common option for first home buyers because it gives you flexibility. Now, the advantages of a variable rate are you can usually make unlimited extra repayments. You get access to features like offset or redraw. If rates fall, you do benefit, and it can be easier to refinance later because there are no break costs. Now, the disadvantages of a variable rate are if rates rise, your repayments will increase. It can be harder to predict for long-term budgeting. You need to be comfortable with some movement and have buffers in place in case rates rise. Now, a fixed rate locks your interest rate for a set period, usually 1 to 5 years, and your repayments stay the same the whole time. Now, the advantages of a fixed rate are it's easier to budget because repayments don't change, you're protected from rate rises, and it gives you a sense of stability. Now, the disadvantages of a fixed rate are extra repayments are usually capped or not allowed from certain banks. You may have to pay break costs if you want to refinance, sell, or repay early. Most fixed loans don't include offset or redraw. And if rates fall, you stay on a higher fixed rate until your term ends. You can also choose a split loan, which is a mix of the two, part fixed and part variable. Chris, fixed versus variable, what's your take on it? And how do you help first home buyers decide which option suits them in the current environment?
Look, it's always a moving target, this one. It's not either always fix or always go variable. It's sometimes, though, it makes a lot of sense for certain clients and at certain times in the market to fix but often it doesn't. And often the variable rate is depending on the discount you negotiate, depending on whether you paid lender's mortgage insurance or what the interest rate the bank's offering. There's usually an alternative option to fix, and you've really got to weigh it up and go, is it worth kind of paying that rate, which sometimes it's higher and sometimes it's lower. And it's really sort of having a gamble on where you think rates are going to go. But a big misunderstanding a lot of first home buyers have, which is fair enough, first time you've ever had a loan, is that you've got to fix it all, you've got to keep it all variable. And often though, when we are doing with clients, we're never doing that. We're sort of saying, well, if you are going to fix a certain portion, but often it's at least 50%, sometimes more you're fixing, because if you are going to have a fix your loan, there are challenges which we'll talk through.
Yeah, and I think you're right, Chris. When you are looking at fixing a certain portion, what that does is allow some of that portion to be variable and gives you access to things like your redraw, your offset, and your extra repayment. So it keeps that flexibility open. So we've talked about fixed and variable. Now let's talk about who actually decides your rate, because often you'll hear things like the RBA increased rates today, or banks didn't pass on the full cut, and it can feel a bit confusing. So let's break it all down. Now, the Reserve Bank of Australia, or the RBA, is Australia's central bank. One of its big jobs is to set something called the cash rate. Now, the cash rate is the interest rate banks pay when they borrow money from each other overnight. You can think of it as the base rate for money in Australia. Now, the RBA meets regularly across the year and decides whether to keep the cash rate the same, increase it, or decrease it. And when they make that decision, they are looking at things like inflation and the cost of living, how strong or weak the economy is, unemployment and job growth, and how confident businesses and consumers are feeling. Now, if the economy is running too hot and prices are rising too quickly, they may increase the cash rate to slow things down. Now, if the economy is struggling and they want to encourage spending and investment, they may cut the cash rate to make borrowing cheaper. So the RBA doesn't set your home loan rate directly, they set the cash rate, which is the starting point. Now, from there, each bank sets its own interest rates. The cash rate is a big influence, but it's not the only thing they look at. Banks also consider their costs of funds, so what it costs them to get money from the RBA, other banks, and global markets, their business costs and profit margins. They need to lend at a higher rate than they borrow to make money. The competition. So if other banks are offering sharp rates, they may sharpen theirs too. And finally, risk. Things like the type of loan to value ratio, borrower profile, and product features. And that's why one bank might pass on the full RBA move, another might pass on only part of it, and sometimes a bank will change rates even when the RBA has done nothing. So your mortgage rate is really influenced by the RBA cash rate, the bank's cost and decisions, and your specific loan and situation. Chris, do you find that banks usually follow each other after an RBA increase or decrease?
Yeah, I think you made a good point here, Jack, that when the RBA does change the rate, it doesn't automatically change the bank rate. The bank then decides whether they're going to pass it on in full or whether they're going to increase rates by the full amount. And there is sometimes a little bit of a game that the banks will play here. They try to get the first one to release that they're going to back the full cut, or that they're only going to pass on a certain amount. And there is a bit of game playing that happens. But really, if one bank doesn't pass it on and all the other banks do, it's not great, right? They don't look great. So they've been very hesitant, not just following the tribe and just all doing the same amount. But it does make it difficult. There is times when rates are increasing a lot or decreasing a lot, and those small amounts, but they're not following each other, start to make some big differences in terms of the rate they're offering for clients. So yeah, it's really important that you sort of track when rates are going up and down, just to see how your bank is actually behaving compared to the market.
Yeah, and I think that's a good tip, Chris, is to really be across what your bank is doing. And if you are in the process and you haven't got that loan yet, and you're in that process of talking with a broker, they'll be able to update you on what them changes are and when the banks are going to pass on them rates, either increases or decreases as well. So, what does this all mean then for you as a first home buyer? So, if you are on a variable rate, when the RBA moves the cash rate, your bank will decide whether to move your rate. If they increase your rate, your repayments go up. If they decrease your rate, your repayments go down, or more of what you pay goes to the loan balance instead of interest. Now, banks tend to pass on increases quickly, often the next day, but decreases are usually slower, sometimes weeks slower. Now, if you're on a fixed rate, changes to the cash rate don't affect you straight away. Your rate stays the same during that fixed period, but when your fixed period ends and you roll to a variable rate or refix, the cash rate at that time and the bank pricing will be reflected in your new rate. So, Chris, why do we usually see banks start increasing their fixed rates before the RBA actually moves the cash rate?
Look, the banks have always got a cost of funding, and particularly with fixed rates, is they're sort of locking in a certain amount of funding. So when banks are looking to price fixed loans, they're not so much looking at the sort of the daily sort of cash rate and the bank sort of swap rates. They're looking at sort of what funding can they lock in for, the fixed term, and what price are they going to pay for that. And when they fix rates, they basically lock in that deal. So they know they're going to make a certain margin on your loan over that period. And so when the cost of funding changes, and not just the immediate, but over, 3, 4, 5 years, and that can shift just due to bond yields and sort of repricing on the expectations on, future inflation and future growth and future interest rate changes. The bank's access to capital, the cost that they pay actually changes. And so sometimes banks make a little bit of a play. They say, look, we're really confident on where interest rates are going to go. We're happy to sort of, pay a little bit less on a fixed rate for a customer. And then they want to get a bit of market. So that's just them sort of pricing and going, well, based on where rates are going to go, how much margin they want to make, and then they basically release their fixed rates. So fixed rates can vary quite dramatically bank to bank. Variable rates, not so much, but in the marketplace, often you can find one bank that's offering a very good fixed rate versus compared to the competitors. And so whenever you're fixing, you really need to make sure that the fixed rate that you're fixing at is competitive, not just compared to your variable rate, but compared to other fixed rates in the marketplace. You can very easily get yourself caught out, and it might make sense to refinance and fix at a different bank.
Yeah, and that's a really good point there, Chris, as well, is looking at your whole situation, comparing different lenders and seeing what feels best for your situation. The banks are obviously looking into the future when they set these fixed rates. So it's just about comparing all your options. Now, looking at rates overall and looking at the rate trends over time, we've had a pretty unusual few years. So during COVID, the cash rate hit 0.10%, the lowest in Australian history. And that was an emergency setting and not normal. And then as the world reopened, inflation spiked and the RBA lifted rates quickly to slow things down. And now in 2025, the cash rate is sitting at 3.6%, which is actually much closer to long-term averages. So even though some people feel today's rates are high, it's mostly because people are comparing them to that temporary COVID low. Now, Chris, what do you think of the current rate environment? I feel like a lot of first home buyers are still comparing today's rates to what we saw during COVID. And how are you framing the conversation with clients at the moment?
You've got to focus on the things you can control. And we don't know where rates are going to go over the coming years. But if you are making a decision to potentially fix, it's really looking at your personal finances and going, look, because fixed rates at the moment are actually lower than variable rates. They have changed a little bit in the last month, but it's kind of looking at it and going, well, is it just good for us as a family to know our repayments aren't going to change much over the next, 2, 3 years? And we really just want to protect ourselves in case rates stay a little bit higher. This really just means that we don't have to worry if there is an inflation spike and rates start to go back up, which has been a fear over the last few weeks. And so if you want to just remove that risk and just focus on other things in your life, then absolutely maybe fixing is a good idea, potentially. But you always have to worry. It is a bit of a gamble. And so you maybe don't fix half. Maybe you fix all. You might fix half and you might keep half variable. And so if rates do go down, you don't just really hamstring yourself and lock all your mortgage on a big debt. There are times, though, like in 2021, 2022, where we had all-time low fixed rates under 2%. And we were fixing 80, 90, sometimes the full investment loans are, sub 2%. We went through our whole book of clients and, clients fixed for 3, 4, 5 years under 2%. But those are very rare times, like you say, Jack. And that bet was obviously very good. But yeah, I mean, the variable rate's always moving. It's something you can sort of track. It's called the ASX tracker, which sort of has the expectations on where rates are going to be over the next, 12, 18, 24 months. And I track that pretty tightly because that gives you a really good understanding of, if there is going to be rate cuts on the horizon, and it allows you just to prepare today, okay, well, maybe we need to be still conservative with our spending. There's not going to be many rate cuts in 2026, but rate volatility changes a lot. And so, you've got to really watch it quite closely, particularly for the last 5 years when there's an inflation outbreak, is that you've got to really know that, that no one really knows what's going to happen, and new data can change rate expectations really fast.
Yeah, so like you said, Chris, it's about coming back to your own personal situation and what suits your budget and your lifestyle. But again, that ASX tracker, we'll chuck a link to that in the show notes as well, so anyone listening can jump on and have a look at that. It is a really good tool to kind of look and plan. But as you said, Chris, no one can actually with 100% confidence know what the rates are going to do. It can move very quickly. All right, so now that we have talked about how interest rates are set and why they move, let's bring it back to what really matters for first home buyers, making sure your repayments feel comfortable today and in the future, because rates will move over time. They always have and they always will. So the goal isn't to predict the future, it's to be prepared for it. So the first thing is to check whether the repayments at today's rate feel genuinely comfortable for you. That's your baseline. If the repayment already feels tight, a rate rise is only going to add pressure. And that's why it's so important to stress test your numbers. Lenders do this too. Most assess your application using a 3% buffer. So if the rate today is 5.5%, they test whether you can still afford the loan at 8.5%. It's a safety net, but it's still important to think about your comfort level, not just what the bank says you can handle. And this is where knowing your numbers really matters. You really need to understand what it costs you to live, your fixed bills, your groceries, your commitments, and the basics. And then ask yourself, if rates increase, how would I manage that? Do I have the cash flow to handle higher repayments? And are there levers I can pull, like tightening discretionary spending for a bit? Now, when you combine all of this, stress testing, having a buffer, and knowing your budget, rate movements become far less intimidating. They're no longer a shock, and there's something that you've already planned for. Now, Chris, how important do you think it is for first home buyers to stress test their numbers and plan for future rate rises? And how do you help clients prepare for the fact that rates will move over time?
Yeah, I do think you got to be careful here, Jack. Obviously, I think the most important thing is to look at your personal spending, what your fixed costs are, what your variable costs are. And a lot of people in the market sort of don't give first home buyers the credit they deserve. And they say, oh, they're going to over leverage and you have to sell their homes. No, people naturally change their behavior when they've got an asset and they've got a mortgage, and they start to, naturally just evolve to a new type of, situation quite quickly. And maybe they would have gone out for dinner pre-owning. Now they've decided just to, have dinner at a park and a picnic and, save themselves a couple $100. And so priorities change and people's spending shifts. So firstly, just note that, and realize that those compromises are worth it if you've got an asset and you're not renting, you've got an asset growing for you now. The second thing is just be really careful. Yes, the bank does stress test you, but it's done on a certain living expense. And what you want to do is really just make sure that that's actually a sustainable living expense for yourself, and how your income's going to change over the coming years. Might be having changes with new jobs. You might be going up or down in pay. Your partner may be taking time off, or you might be taking time off. And just everyone's got different cash flow, both income and expenses, and different commitments they can and can't change. So really understand yours. Don't accept the bank's number. And even after, it's not just do it now. It always just maybe come back as a family and a couple just to go, look, we thought that's where we were going to be 6 months ago, but things have changed. We've got a pay rise, but actually, no, some of our costs have gone up. We've got childcare now, whatever it might be. So just constantly review it, just to give you that peace of mind that you're going to be okay.
Yeah, so your interest rate does matter, but like we're talking about, your strategy matters more, and knowing your budget, because you can't just set and forget your home loan. Rates move, your life moves, and the market moves. So managing your home loan is something you need to stay on top of, not just when you first buy, but throughout the entire time you're paying it off, like you just mentioned, Chris. And one of the biggest traps people fall into is something called the loyalty tax. And that's where existing borrowers quietly end up paying more than new customers simply because they haven't reviewed their home loan in a while. Banks reward new business, not long-term loyalty. And that's why we do regular reviews, and they're so important. We check in with our clients every 6 months. Sometimes we renegotiate a better rate. Sometimes we refinance. Sometimes the strategy needs a shift because life changes. You've got income changes, family changes, future property goals, whatever it may be. And here's the message. The cheapest interest rate isn't always the best loan. Strategy is about the whole picture: borrowing power, buffers, features, flexibility, your future plans, and choosing a high quality asset. So yes, your rate does matter, but the way you use your loan, the actual property you choose, and the strategy you follow will have a far bigger long-term impact than chasing a rate that's 0.05% cheaper. So Chris, when you're working with clients, how do you help them think just beyond the interest rate and focus on the overall strategy instead?
Oh, look, I think the most important part is looking at not just what your repayments are going to be, but what buffer you've got. And so, yes, repayments might feel a little bit higher than you want, but if you've got a big buffer, is that such a big issue? However, if you are stretching every single dollar, you're running it really tight, you're really being maybe optimistic on your potential living expenses, you've stretched, you've got big commitments, your work volatility is going to potentially change. You've just got to be, I guess, real with it and go, look, maybe I should just maybe be a bit more conservative here because I know there's a lot of uncertainty coming up. But often clients are more conservative than aggressive, and they're already putting those sort of, I guess, mental hurdles on themselves. And I guess it's really when you come out post-purchase, what cash are you going to have left over? And the bigger that number, the less concerned you need to be. And so focusing on the structure, how do you maximize your buffer? How do you also reduce your repayments? And also give yourself, obviously get the best interest rate that's going to protect you over the next couple of years as well. There is a danger where people going with introductory rates and banks that, interest rates can change on you when you get a good deal today and not a good deal in a few years, which we'll cover in a future episode. But that's the main part of it.
Yeah, and I think you're right, Chris. It's definitely important to have them buffers. We always talk about them buffers to start your first home. There's also that strategy side of things as well when you're looking at the actual property. If you are stretching your budget a little bit more, is there a suburb that's next to that suburb that you are looking to purchase in that might give you more room in your budget and still get you a good quality asset that you were looking for? But is it cheaper to move outside of that major city? Is it cheaper to go to commute a bit further to work? So these are all things that you can kind of weigh up in your strategy and talk through the options with your broker and work out what kind of best fits your situation. So to recap today's episode, interest rates are simply the cost of borrowing money. Your rate will move over time, and that's normal, and it's something you need to plan for. The RBA sets the cash rate, but banks set your actual mortgage rate based on their own costs, competition, and risk. And while your interest rate matters, your overall strategy, your structure, your features, and choosing a high quality asset matters even more. And if you are ready to make a plan, you can book in a get to know you chat at firsthomeunlocked.com.au/book or use the link in the show notes. Thank you so much for listening. We'll see you on the next episode. Chat with you then, Chris.
Thanks, Jack. Talk soon.
Thank you so much for listening. We'd really appreciate if you could do us a huge favor. Share this episode with any first home buyers that you know so we can help more people like you feel clear, calm, and confident when purchasing their first property. You can join our Facebook group, First Home Unlocked, to continue the conversation with other first home buyers. Or if you're ready to unlock your first home, you can book a get to know you chat by using the link in the show notes or by going to firsthomeunlocked.com.au. Before we go, just a reminder that everything we share on this podcast is general in nature and not tailored to your personal situation. We always recommend seeking advice from a qualified and experienced professional when making financial decisions.